Welcome to the first lecture for week 9, chapter 10, Making Capital Investment Decisions. This week we have a couple of topics to look at. Chapter 10, Capital Budgeting and Cash Flows, Incremental Cash Flows, some pro forma financial statements, operating cash flows, replacement decisions, and discounted cash. First, we're going to take a look at the capital budgeting and cash flow process and how these two interrelate. In Chapter 9, we looked at multiple techniques of capital budgeting to evaluate projects. We looked at some of the strengths and weaknesses and when the different techniques were appropriate. And this chapter is about how each of the cash flows are determined. There's more detail in your text than I'm giving you in the lecture. I just want to make sure from the lecture that you understand what the principles are from a conceptual level. This is our example we looked at before where we have the $165,000 initial investment, cash flow 1, 63,120, cash flow 2, 7,800, cash flow 3, 91,080, with the required return for assets at this risk level as 12% is determined by the firm. So what we're going to look at is where these cash flows come from. How do we determine what they are in the future? Instead of just sort of stating that they exist, there needs to be some basis for determining them. We're going to examine some of the ways that we can determine them. What the principle is here is that we should be looking at incremental cash flows. What's relevant? The cash flows that should be included in a capital budgeting analysis are those that will occur or only occur if the project is accepted, or those that will not occur if the project is accepted. And these are known as incremental cash flows. They will occur only if the project is accepted or will not occur if the project is accepted. They are a change as a result of project acceptance. The standalone principles allows us to analyze each project in isolation from the firm simply by focusing on the incremental cash flows. So we look at what is changing as a result of accepting or rejecting an individual project. The key is to ask the right question when we do a project assessment. And the question is, will this cash flow occur only if we accept the project? That's the question. So if we accept this project, will the cash flow occur? If the answer is yes, the cash flow should be included in the analysis because it's incremental. If the answer is no, it should not be included in the analysis because it will occur anyway. It's something that is an ongoing cash flow. If the answer is part of it, then we should include the part that occurs because of the project. This is the delta, and this is what we should be looking at. There are common types of cash flows associated with projects. Should we include sunk costs in the project analysis? No, because they're sunk, they're accrued, they're not going to change regardless of whether or not the project is implemented. Opportunity costs, these are cost of loss options. Yes, these should be included. Sometimes these are difficult to estimate. Changes in net working capital, yes, these should be included. Financing costs, no, because these are related to the general operations of the firm. Taxes, yes, because they're related to incremental income and marginal tax rates. And finally, we need to include some of the side effects. If we have positive side effects, we're going to get benefits to other projects, and negative side effects are costs to other projects, so we should include these as well. In determining cash flows, we prepare pro forma financial statements, and we looked at some of these earlier. We can see here that we can prepare a generalized pro forma income statement based on certain sales levels and based on certain variable cost levels. Again, these are all based on the assumptions around which the different cost categories are. What we want to focus on for the budgeting process is our operating cash flows. So if we are going to look at some projected capital requirements, we see net working capital and net fixed assets are adding up here, and we're going to see this in a minute with why this is important. So we need to add together our changes in net working capital plus our changes in net fixed assets to arrive at a meaningful figure, because these are the capital requirements for each year. What these are is these are cash flows from assets. And this is very important when we do our calculations, because this determines what our cash flows are going to be as a result of using assets required for the project. So again, these are all incremental cash flows. This is a way of calculating it. With our visual, again, we see that we have our timeline. We have the negative 110,000 initially, cash flow 1, 51,780, cash flow 2, 51,780, cash flow 3, 71,780, and if the required return for assets of this risk level is 20%, should we take on this particular project? The key here is calculating these cash flows, looking at cash flows from assets. So the net present value of 10,648, internal rate of return of 25. So what's your decision? Deal or no deal? We should take the deal. Depreciation is another area in capital budgeting that's very important because it's a non-cash expense and can reduce net income and reduce the tax burden. The depreciation expense used for capital budgeting should be the depreciation schedule required by the IRS for tax purposes. Depreciation itself is again a non-cash expense, and it's only relevant because it affects taxes. It may or may not reflect the actual situation of the equipment, because market values can fluctuate based on factors such as inflation, regional prices, things like this. We have a depreciation tax shield, which is a depreciation expense times a marginal tax rate. So depreciation tax shield we can use to determine what our benefits are going to be from depreciation in terms of the assets needed for a particular project. There's multiple kinds of depreciation. I think the simplest is straight line. I think we can use that for this class. The initial cost minus salvage over a number of years. Very few assets are depreciated using straight line for tax purposes. For this class we'll use it, but for the MACRS we put different assets in different classes according to the nature of the asset. And so this is a very common form of depreciation. The after-tax salvage value of assets used on a project is very important, because if it's different from the book value, then there's a tax effect. We have to pay taxes on the difference. The book value is the initial cost minus accumulated depreciation, and it may be zero, but the after-tax value is salvage minus book minus the salvage minus book value at the time of sale. So the after-tax salvage may be greater than the book value, and then the taxes would be accumulated on the difference. So what we have is market value minus book value. If it's greater, is a gain or there's a loss. We take the gain or loss times marginal tax rate, and then we pay taxes on a gain, receive a tax benefit on a loss. So what we want is we want the market value to be less than the book value. The after-tax salvage, again, is equal to market value minus taxes paid, or market value plus tax benefit if it's negative for a loss. The replacement decision is very important, especially in the environmental field, because many forms of equipment for environmental control will end up exceeding their useful life, and you as an environmental manager may have to determine whether or not the equipment is replaced. So the replacement problem is different. Every problem we've looked at so far represents a newly purchased asset, but the replacement problem is a little different. What if we have to replace an old asset to replace? What if we have an old asset to replace with a new asset? We have to buy something new because the old one simply is worn out, or there's a new and better tech out there. So if we look at this problem, we have the original machine, initial cost of $100,000, annual depreciation of $9,000 5 years ago. The book value is $55,000, salvage is $65,000, so the salvage in 5 years is $10,000. The new machine is $150,000, 5-year life, salvage in 5 years is zero. Cost savings $50,000 per year, 3 years MACRS depreciation, required return 10%, tax rate 40%. Should we replace a machine? So remember, you can actually see how this example is calculated in your text. But in terms of computing cash flows for replacement problems, remember, we're interested in incremental cash flows. So if we buy the new machine, then we sell the old machine. What are the cash flow consequences of selling the old machine today instead of? Well, we look at this on a comparative issue. Again, there's more detail in your text, but here we can see that in year 2, the cost savings from the new machine uh, generates a negative or negative net income in year 2, but positive in year 3, 4, and 5. So in year 0, the cost of the new machine, 150,000 outflow after tax salvage on the old machine, the 65,000 minus the tax rate, so it's 61,000 inflow. So the incremental net capital spending is about 89,000, which is an outflow. In year 5, the after-tax salvage is about 10,000. This is also an outflow because we no longer receive this. So what we want to see is what is the cash flow from assets in this particular replacement problem. We see here that the cash flow from assets varies over time as depreciation changes and the salvage value varies. So now that we have the cash flows, we can compute the net present value and the internal rate of return. The net present value for the replacement is 54,801. Internal rate of return is 36.28%. So should the company replace the equipment? Yes. There are some ethics issues around equipment replacement. This is rather interesting. We have an LA law episode. An automobile manufacturer knowingly built cars that had a significant safety flaw. Rather than redesigning the cars at substantial additional cost, the manufacturer calculated the expected cost of future lawsuits and determined it would be cheaper to sell an unsafe car and defend itself against lawsuits. And so really the ethical aspects are very important on some of these financial analysis. In fact, you'll see that based on the probability of enforcement and enforcement fines, organizations are going to want to do the same thing. They are going to, rather than redesign their processes, they're going to pollute and run the risk of incurring fines and lawsuits rather than redesign the process and invest in new capital equipment. So it's going to be up to you to persuade them to do that. So our terminology for this chapter, we need to understand incremental cash flows, sunk costs, opportunity costs from the economics part of the class, standalone or independent projects, net working capital, go back to chapter 1, operating cash flow, chapter 1, cash flow from assets, straight line depreciation versus MACRS depreciation, what are they, how are they different? The market value versus book value, how are they different for assets that are being sold? And what is the after-tax salvage value of an asset, as well as the bid price? Don't focus too much on cost. We're not going to really worry about that, but just know that these are some of the formulas you may be working with for operating cash flow and cash flow from assets, as well as after. So what are some of the most important topics of this chapter? The cash flows for a project are computed using incremental cash flows, considering depreciation and after-tax salvage values. They are the cash flows that occur only if the project is accepted. They are the delta. Straight line and MACRS methods of depreciation are used to compute the depreciation of an asset. There's two different cash flows from assets computes the annual cash flows for capital budgeting purposes. It's the cash flows that occur as a result of using assets to generate income from a project. And replacement decisions involve the cash flows of the old asset as well. So if you have any questions, ask them in the Q&A forum. Otherwise, we will see you on the class show.